Hey everyone, and welcome to another deep dive. Today we're taking a close look at Invesco's 2025 investment outlook. We'll break down their predictions and really try to focus on what matters most to you.
Sounds good.
So think of it this way. Imagine the global economy as a plane coming in for a landing. Are we headed for a crash landing? A recession? Or will it be a smooth, controlled touchdown? What economists like to call a soft landing.
Well, Invesco seems to be putting their money on the soft landing. They're predicting global growth will slow down a bit initially, but then pick up speed again by 2025.
Interesting. And are they just being optimistic here, or is there actual evidence to back this up?
Oh, no, they've definitely done their homework. They've analyzed a bunch of factors like central banks easing up on those monetary policies, the surprisingly strong U.S. labor market, and those pretty healthy household balance sheets we're seeing in both the U.S. and Europe.
One thing that really caught my attention was that global PMI data is showing steady growth. But it's mainly driven by the services sector. Can you explain what that means, and why is this such a big deal, especially after everything that's happened since the pandemic?
It really shows you how the global economy is changing. The services sector, think healthcare, technology, education, even what we're doing right now with this podcast. It's becoming a major force. The pandemic actually sped up this whole shift. And Invesco thinks this trend is here to stay.
So if Invesco is right, we could be looking at a pretty good environment for riskier investments. But before we get ahead of ourselves, let's talk about what central banks around the world are up to. You're the expert here. What's the overall picture?
Central banks are definitely shifting gears. It seems like their focus is moving away from battling inflation and towards getting that growth going again. We're probably going to see a global wave of rate cuts, which means central banks will lower interest rates to encourage people to borrow and invest.
Now, this is where it gets real for our listeners. If you're thinking about taking out a loan or making a big investment, these rate cuts really matter. What should people be paying attention to as this all plays out?
The important thing to remember is that not all central banks move at the same speed. For instance, the U.S. Federal Reserve. They're aiming for what they call a neutral policy. They're trying to find that sweet spot where rates aren't too high or too low. Then you have the European Central Bank. They're dealing with slower growth and will probably cut rates more aggressively. And then there's Japan. They're actually in a tightening cycle.
Wow. It's like a global economic chess match with each central bank making its own strategic moves. But let's get back to investing. Invesco keeps mentioning a risk-on environment. What does that even mean for someone who's not a Wall Street insider?
It's actually pretty simple. Risk-on means investors are feeling more confident about the economy and are willing to take on more risk with the hope of getting bigger returns. Instead of sticking to those safe havens like government bonds, they're starting to explore investments that could be more volatile.
So less playing it safe and more, let's go for it.
Exactly. Think stocks, especially in emerging markets or those smaller companies. And even some types of bonds that offer higher yields but also come with more risk.
So if you're an investor who can handle a bit of a roller coaster ride, this might be the time to look into those opportunities. But Invesco also points out a few swing factors, things that could really throw a wrench in their predictions. I think understanding these is crucial for anyone making investment decisions.
Absolutely. Invesco has zeroed in on 4 main swing factors. First, we have the impact of President-elect Trump's policies, especially when it comes to trade. Second, there's the possibility of China stepping in with some stimulus measures to boost global growth. Then there's always the risk of inflation making a comeback. And finally, we need to consider how potential fiscal pressures might force governments to change their spending habits.
Wow, that's a lot to think about. Each of those swing factors could create opportunities and challenges. For example, Trump's trade policies could impact certain industries or regions in ways we don't expect. And if inflation comes back, it could eat away at your savings. And changes in government spending could affect everything from infrastructure projects to social programs. It feels like trying to navigate a maze.
It definitely is a constantly changing situation. That's what makes it so fascinating, though. By understanding these swing factors, you can start to make smarter, more strategic decisions about your finances.
I think that's a perfect place to pause for now. We've covered a lot, setting the stage for a deeper exploration of Invesco's outlook. In part 2, we'll dive into those investment implications and break down what these predictions could mean for your portfolio. We'll cover everything from stocks and bonds to real estate and alternative investments. We'll even touch on how currency fluctuations play into all of this. So stay tuned for part 2, where we'll really get into the nitty-gritty of what all this means for your money.
Welcome back to our deep dive into Invesco's 2025 investment outlook.
So in part 1, we laid the groundwork. We talked about their predictions for the global economy, how central banks are changing things up, And of course, those swing factors that could really shake things up.
Right. We saw that Invesco is cautiously optimistic about a soft landing for the global economy.
But the financial world is full of surprises. So let's focus on what all of this means for your investments, your portfolio.
Okay, let's get practical.
Yeah.
We'll look at what Invesco's predictions could mean for different kinds of investments. Everything from stocks and bonds to real estate and even those more exotic alternative investments.
Perfect. Now, you mentioned earlier that Invesco is predicting a risk-on environment. Can you remind us what that means, especially for someone who's just trying to make smart investment choices?
Sure, a risk-on environment basically means investors are feeling a little more confident about the economy, and they're willing to take on a bit more risk in hopes of getting those higher returns. So instead of playing it safe with things like government bonds, they're starting to explore investments that could be more volatile.
So less playing it safe and more let's go for it, like we talked about before.
Exactly. Think about stocks, especially in those emerging markets or smaller companies. And even some types of bonds that offer higher yields, but also come with that added risk.
So if you're the kind of investor who can handle a bit of a roller coaster ride, this might be the time to check out those opportunities. Let's start with equities. What's Invesco's outlook on the stock market?
Overall, Invesco is pretty bullish on equities, especially in non-U.S. developed markets. They're looking beyond the U.S. stock market, seeing some opportunities in places like Europe and Japan.
Interesting. So diversifying internationally, what's the thinking behind that?
They believe valuations are more attractive in those regions. Basically, stocks might be undervalued compared to their potential, and they think the economic recovery in those areas could pick up steam as those central banks continue to ease monetary policy.
Makes sense. So potential for growth outside the U.S. What about the U.S. stock market? Are there any specific areas they're highlighting?
Within the U.S., they're particularly interested in small-cap stocks and what they call value sectors. Small-cap stocks are shares of companies with smaller market capitalizations. Think of it as the total value of all their shares. They tend to be more volatile than the big companies, but they also have the potential for higher growth.
So a bit more risk involved, but potentially a bigger payoff if things go well.
Precisely. Now, value stocks are shares of companies that are considered undervalued by the market. They might have strong fundamentals, but are trading at a lower price than they probably should be relative to their earnings or other factors.
So it's like finding a hidden gem in the market.
That's a great way to put it. Invesco thinks both small cap and value stocks are in a good position to benefit from the economic recovery and that easing of monetary policy we talked about earlier.
Okay, so a lot to consider when it comes to stocks. Let's move on to fixed income. What's the outlook for bonds?
Invesco expects something called duration to perform well as central banks continue to cut interest rates.
Hold on, I think we need to break that down a bit. What exactly is duration? And why does it matter in this context?
You're right, it can sound a bit technical. Duration is basically a measure of how sensitive a bond's price is to changes in interest rates. The higher the duration, the more a bond's price will fluctuate as interest rates go up or down.
So if interest rates are falling, which we've talked about is a likely scenario, bonds with higher durations should see their prices go up.
Exactly. That's why Invesco is bullish on duration in this environment. They believe the ongoing trend of rate cuts will be good for bonds, especially those with longer maturities.
Okay, so that's duration. What about different types of bonds? Are there any specific sectors or regions Invesco is calling out?
They're kind of positive on high-yield bonds, but they're also a bit cautious because valuations are already pretty high. This means there might not be much room for price appreciation.
So maybe proceed with a bit of caution there. What else are they suggesting?
Invesco also thinks bank loans could be an interesting option. These loans are usually floating rate instruments, which means their interest payments adjust as market interest rates change.
So they offer some protection if interest rates start to rise again.
Exactly. It's a potential hedge against that happening. And finally, they're neutral on emerging market bonds. While valuations are fair, a lot of the potential return is concentrated in the more distressed segment, which carries higher risk.
Got it. So a lot of nuances to consider with bonds. Now let's talk about real estate. It's an asset class that many people find a bit more tangible and relatable. What's Invesco's take on real estate?
They're seeing some interesting developments. For one, they think central banks shifting towards easier monetary policy is a positive turning point for real estate.
Also,
Lower policy rates can lead to lower borrowing costs for real estate investors, which could stimulate the market. Plus, lower interest rates can also mean lower costs for commercial and residential tenants, potentially boosting demand.
so a potential win-win for both investors and renters.
Exactly. Invesco is particularly optimistic about commercial real estate. They point to a dip in valuations and the stabilization of what are called cap rates. Basically, those measure the potential rate of return on a property investment, as signs that a new cycle of transactions could be coming.
So it sounds like they're sensing some positive momentum in the commercial real estate market. Now let's get into those more exotic investments. What about alternative investments?
Ah, yes. The world of hedge funds, private equity commodities, investments that fall outside those traditional categories of stocks and bonds.
Exactly. It can feel a bit like the Wild West of investing sometimes.
Invesco suggests a strategic approach here. They favor private debt and hedge strategies over private equity. They think private debt, which includes things like lending directly to companies, offers attractive returns compared to more traditional credit strategies.
So potentially higher returns, but with less flexibility to quickly buy or sell those investments.
That's right. As for hedge strategies, they're trend-following strategies, which try to profit by riding the momentum of market trends. These strategies have historically done well in both rising and falling interest rate environments.
Interesting. So they're not just betting on the market going up or down. What about private equity? They seem less enthusiastic about that area.
They are a bit more cautious on private equity. They point to high valuations and what's called dry powder. That's basically uninvested capital just sitting there waiting as potential challenges.
So maybe it's a bit harder to find those really good deals in private equity right now.
That's their take. And of course, we can't forget about commodities, those raw materials that the global economy depends on.
Right, things like oil, gold, copper, agricultural products, the stuff the world runs on.
Invesco is staying neutral on commodities overall, so they don't see any super strong opportunities or risks in that area right now.
Okay, a balanced perspective on commodities. Before we move on, I want to go back to something you mentioned before, currency fluctuations. Those can really impact investment returns, especially when investing internationally.
Absolutely. And Invesco knows that. They point out that the US dollar has been pretty strong lately, but they expect that to moderate as the Federal Reserve keeps cutting interest rates.
Because lower interest rates make the US dollar less attractive to foreign investors.
Exactly. And as the difference in interest rates between the US and other countries shrinks, the US dollar could weaken.
Which could be good news for US companies that export their products, but it could also affect the returns of US investors who hold assets in other countries.
It's a trade-off. Invesco thinks the British pound and the Japanese yen might get stronger against the US dollar, so there could be some interesting currency moves to watch.
Okay, so we've covered a lot of ground here. Stocks, bonds, real estate alternative investments, and even currencies. We've given our listeners a pretty comprehensive overview of the investment implications of Invesco's 2025 outlook. But before we wrap up this part, I want to make one thing really clear.
Sure, go ahead.
This is just one perspective. Invesco's outlook is based on their analysis and their best guess about what the future holds. But as we all know,
The future's always changing.
exactly, no one has a crystal ball. So it's important to take any investment outlook, including this one, with a grain of salt.
Do your own research. Talk to a financial advisor. And make sure any investment decisions you make fit your own risk tolerance and your financial goals.
Well said. Now, in part 3 of our deep dive, we're going to switch gears again and really dig into those swing factors we mentioned earlier.
Those potential curveballs that could throw Invesco's predictions off course.
Exactly. We'll explore the impact of President-elect Trump's policies, the possibility of China taking action to stimulate their economy, the risk of inflation coming back, and how changes in government spending could shake things up.
This is where things get really interesting.
Definitely. So stay tuned for part 3, where we navigate those unpredictable swing factors.
Welcome back for the final part of our deep dive into Invesco's 2025 investment outlook. We've talked about their predictions for the global economy and how all of that could impact your investment portfolio. But there's one more piece of the puzzle to look at. Those unpredictable swing factors that could really shake things up.
Yeah, these are the wild cards, the things that could make things really interesting. So let's make sure we understand what they are and how they might impact the economic landscape.
Right, those unexpected events that could send everything off course. So let's jump right in, starting with one that's been getting a lot of attention. The potential impact of President-elect Trump's policies.
Trump's presidency brings a lot of uncertainty, especially when it comes to trade policy. Remember all that talk about tariffs during the campaign? Those taxes on imported goods? Those could end up leading to higher prices for consumers and businesses here in the U.S., which could then fuel inflation. And it's not just about the U.S., right? Other countries could hit back with their own tariffs. It could escalate into a trade war and disrupt global trade.
Exactly. We're already seeing some businesses reacting to this uncertainty. Some are putting their investment decisions on hold. Others are trying to adjust their supply chains to minimize the potential impact of those tariffs.
So a lot of wait and see happening in the business world. But trade policy isn't the only area where Trump's policies could have an impact. What about deregulation and tax cuts?
Those policies are generally seen as good for business. The idea is that if you cut regulations and taxes, businesses will have more money to invest and create jobs. And that could potentially stimulate economic growth.
It sounds good in theory, but like you said before, the details really matter. How those policies are designed and implemented will be key.
Right. There's always the risk of those unintended consequences. And we also have to remember that Trump needs Congress to pass legislation. So there's going to be a lot of political back and forth.
Definitely adds another layer of complexity. Okay, so the Trump administration is a big question mark. Let's talk about China. We mentioned in part 2 how China's economy has been slowing down, and Invesco thinks they might step in with some pretty big stimulus measures. Do you think those measures are a good idea, given the potential risks?
Well, China has a history of using fiscal and monetary policies to manage their economy. Things like infrastructure spending, tax cuts, and changing interest rates. They have a lot of tools they can use.
But those tools can be risky, right?
Exactly. Stimulus measures can boost growth in the short term, but if they're not managed carefully, they can also lead to inflation. And there's always a chance that they won't be as effective as intended, especially if businesses and consumers are still feeling cautious.
So China's actions are definitely something to keep an eye on. Now let's talk about the I word, inflation. Even though we've seen inflation cool down recently, Invesco says it could come roaring back. Why are they worried?
There are a few reasons why inflation could make a comeback. One is the tight labor market in the U.S. When unemployment is low and employers are competing for workers, wages tend to go up. And those higher wages can lead to higher prices for goods and services as businesses pass those costs on to consumers.
So it's like a chain reaction that can be hard to stop once it gets going.
Exactly. It's that wage price spiral we've talked about before. Another factor is the possibility of oil prices going up. Oil is a key ingredient for lots of goods and services. So when oil prices rise, it tends to push up prices across the board.
And then there are those unexpected events, like natural disasters or geopolitical issues that can disrupt supply chains and send prices skyrocketing.
Right. So even though inflation might be under control right now, it's still a risk that investors need to be aware of.
All right, last but not least, let's talk about fiscal pressures and government spending. I know this might not be the most exciting topic, but it's important, right?
Definitely. Governments around the world have been spending a lot in recent years. First, to deal with the pandemic, and then to support their economies. All that spending has led to higher levels of government debt.
And that debt has to be paid back somehow. What could happen if governments have to start tightening their belts?
If governments need to reduce their debt, they might have to cut spending or raise taxes, and that could slow down economic growth.
Like taking away the fuel that's been powering the economy.
A good way to put it. Now, not all countries are facing the same level of pressure. Some have more room to maneuver than others, but it's something to watch, especially in countries that already have a lot of debt and are experiencing slow economic growth.
Well, we've covered a lot of ground today. We've gone through Invesco's predictions for the global economy, what those predictions could mean for your investments, and all those key swing factors that could change the game. What's the one thing our listeners should take away from all this?
I think the most important message is that the future is unpredictable. No one can say for sure what's going to happen.
So being ready for anything is crucial.
It's exactly.
Yeah.
Diversify your investments. Stay informed about what's happening in the world. And don't be afraid to adjust your investment strategy as needed.
Great advice. And remember, this deep dive was just a starting point. Keep doing your own research. Think about talking to a financial advisor and make sure any investment decisions you make are a good fit for your own personal risk tolerance and your financial goals. That wraps up our deep dive into Invesco's 2025 investment outlook. Thanks for joining us. We hope you found this helpful. And remember, knowledge is power when it comes to navigating the world of finance.